Today, we're going to show you how a team of finance professionals worked over 3 months to develop a strategy that can beat SCHD. Now, SCHD happens to be one of the most popular ETFs out there right now, and it's a dividend growth ETF that identifies stocks that increase their dividends over time. Now, dividend growth matters a lot because of the time value of money. So, in 20 years, $1 today is worth 50 cents. So if you're on a fixed income, such as bonds, then your ability to purchase things, your purchasing power, will essentially halve in 20 years, and your quality of life goes down. So our goal is to solve this problem, and not just solve it, but say, what if $1 today could be worth $3 in 20 years? So your quality of life is going up. Now, for that to happen, you'd need your income to grow at around 9.3%, to offset the 3.3% inflation impact. Now remember that number because it's very important. Now let's review the basics. When dividends for any particular stock get too high, or say the yield gets too high, that's a warning sign. It's also called a value trap. That's because there is no free lunch. This is also applicable for all the gimmicky high-yield investment products in the form of ETFs that we see being debuted left and right these days, some of which we covered like JEPI. Now, when low dividends grow very quickly, let's say low-yield stocks, they become high-yield stocks faster than you would think, and that's this notion of yield on cost. Now, dividend growth is sustainable when it repeats over many consecutive years. This is the idea that the longer a track record a particular company has of increasing their dividend, the more likely it is that they'll continue increasing it. Chevron's a great example of that. When the price of oil went negative, they had their first slide of the investor deck said, increasing our dividend. These are what Warren Buffett calls equity bonds, and many of these equity bonds make up the constituents of SCHD. And here you can see a number of pieces that we've written about this ETF. It's certainly, from our perspective, the best dividend growth ETF going right now. And that's without looking at performance, because looking at short-term performance numbers means very little. You need to understand the underlying product. And in this series of videos, that's what we did. Now, the question that we wanted to answer is, can we beat SCHD? And the answer is yes, we can. And in order to introduce our strategy, we've certainly talked about this any number of times. Our strategy is Quantigence, and it's a tool that helps investors build better dividend growth portfolios. The value in this strategy lies in the rigorous amount of analysis that's gone into refining our Q-score methodology over time, the quality of data that underlies this strategy, which we license directly from NASDAQ, and the tools that it provides to help you build your own DGI portfolio, which is what a lot of our premium subscribers do. So we have the Quantigence reports. I say plural because we're in the process of developing more. The Quantigence calculator, which we've retired from the public domain, and that will debut as a paid subscriber feature only. And this last point, a proven ability to generate alpha. So that's different from just tracking the market. And in order to prove that you generate alpha, you need more than just basic backtesting, which is what we had previously. And it really lacked the sort of academic rigor that we needed. So we can certainly make some correct claims to say that the strategy is recession-proof, transparent, acts like a bond, pays like a stock. 90% of the long-term performance comes from dividends. It beats inflation and beats the market. But to build a financial product on any strategy, you need to do the work. So where we started, and the foundation of Quantigence is really this factor-based approach, which certainly takes influence from the decade that I spent at MSCI, where they developed factor-based investing. So important quantitative measures that we're going to look at using this algorithm that we developed is income growth and likelihood of future increases when we analyze Dividend Champion. So yield tells us what income is. That's fair enough. 5-year, 10-year growth rates of dividends, that's the amount your income's growing, right? Size of the company. So this is where economies of scale come into play. This is very relevant to our study that we did. An increased likelihood of survivability. So these other three factors here, these are really about the likelihood that track record continues and the durability of that. So years increase, right? The longer you have a track record, the less likely you are to break it. Payout ratio, that gives you a buffer there, and international sales. So the question we asked was simply this: can a factor-based approach to dividend growth investing generate alpha? And our rockstar analyst spent 3 months answering that question, and it turns out, yes, you can. So this paper looks into answering that question. It's titled Modeling a Unique Approach to Factor-Based Investing as Part of a Dividend Growth Investing Strategy. And the two BSDs that did this, Livio Luyten and Nicholas Dumont, spent a great deal of time and effort putting this together. And we've produced some videos based on this paper, but today we're just going to focus on section 4, which is the results. Now, if you're a paying subscriber, just drop us an email and we'll send you this paper. So here's the step-by-step approach they took. So first they defined a base selection universe, and then they applied equal weightings across the various industries in the market. There are 11 industries, so they looked to invest in 3 stocks per industry. And the algorithm that they developed selected the best stocks within each sector continuously over time. Of course, the dividends received are reinvested instantly, and this rebalances over time. They actually used a number of methods, but the rebalancing method filtered out stocks, and both methods did rather, that have broken their dividend growth streak. Obviously, if a stock stops growing their dividend, they're kicked to the curb instantly. There's no question about that. So here's the base universe. They looked at the top 90th percentile of years of dividend growth. So that's something we highly value, the number of years that a company has grown their dividend. And of course, size as well, as I mentioned earlier. So they look at the market cap above the median of the remaining stocks. So they take the top half of that. And here is their universe, the number of stocks in that universe over time. And the data set here, licensed from NASDAQ, contains 21,000 companies that this is pulled from, all U.S. companies. As I said, for each 11 sectors, they're taking 3 stocks with the highest Q score. Remember the 7 factors we described earlier? Those produce a Q score. Then they took 2 approaches, linear and rebalanced. So for linear, they simply picked the top 33 stocks at the start. So they did a 23-year back test. So this would have been around the year 2000. The top 33 stocks. They never changed those over time except to kick out companies that didn't increase their dividends. So that's linear reinvesting, what we refer to as linear reinvesting. Then continuous rebalancing. This is where every quarter they would rebalance to an equal weight between sectors with stock allocation based on that factor approach. So if there was a higher Q score there, then they would choose that. And then, of course, to benchmark the exercise, they chose the S&P 500 because that's the most applicable benchmark in this case. Now, before we get into talking about the outperformance, there's a couple of things to note here. First, that the compounding impact of dividends plays a pivotal role in driving the performance, the exponential growth over time. This is what people refer to as the snowball effect, and it's very apparent. You can see that in the chart here on the right showing the value created by reinvesting dividends. Volatility. This strategy reduced volatility because of the deliberate selection of dominant and large cap companies, going back to that size factor. And what this showed is that the Q-score factor-based investing approach was a remarkably skillful stock picker. How skillful? Well, here are the results. So again, somewhere around 23 years of data, dividends reinvested in all 3 cases. The green line would be the S&P 500. The blue line is the linear method, and the yellow line is the continuous rebalancing method. And just remember, this is a logarithmic scale on this chart, so any divergence among these 3 lines signifies an exponential deviation when compared to a normally distributed chart. Now, this strategy of what is referred to as CRB, continuous rebalancing, absolutely spanked the S&P 500, and we believe SCHD as well. Cumulative returns over 23 years. The benchmark S&P 500 with dividends reinvested 540%. Our strategy, 1,252%. So that's an annual return of 13.3% compared to 10%. So that's showing very significant alpha being generated as a result of how this strategy works. And the paper goes into extreme detail on that. Now, when it comes to the linear strategy, this is what we use for our own portfolio because it's very simple. So if we were to develop an ETF on our strategy, it would most likely be around this CRB method, which is why the purpose of doing this paper was to examine how we can optimize the alpha generated by our strategy. But linear outperforms as well, though in the last 5 years, you can see there's definitely a dip that happened around the time of the Rona, and this is where I think the objectivity of selecting those companies 20 years ago and persisting with them, or more than 20, persisting with them over time could certainly lend itself to some subjectivity. Now, when we look at, for example, sectors, you can see that in our current strategy, we simply skip sectors with no constituents, and we overweight sectors with higher Q-score constituents to select from. And you can see here that over time, the communication services sector doesn't have a lot of good companies to choose from. So this strategy actually had points in time where it couldn't find a valid company to include, so it simply just included less and equally weighted them. Another interesting thing here is when we look at Q-score drift over time. So this is an example of CVS versus UNH over a decade and Q-score drift. And those spikes you see that we've pointed to here with the arrows, those we're looking to smooth those out. For example, the recent change we did on payout ratio, instead of looking at last quarter, we look at rolling last 4 quarters. That certainly helps smooth this out. But you see that deviation there, that could certainly be a signal that some problem is happening, and for investors to evaluate that. Walmart's a good example of a Q-score drift, since we've been invested in them in a very long time, but they certainly had their Q-score drift downwards, although we'd argue that we'd still want to continue holding that stock. Walmart's investing in technology. We believe that will show returns down the road. So some subjectivity there, right? Whereas Walgreen Boots Alliance, they might be one that we could have culled, similar to the above when we saw that Q-score drift. And we did notice that it just blew up a lot quicker than we thought. Now, moving on to the factor comparison. So a couple things to note here. Investigating the explanatory power of these factors could be another step to take. So in future work, you could certainly apply some Pareto optimization, so where any specific Q-score would be maximized without compromising others. We used to do this sort of thing at MSCI. Now, in this study, for 10-year dividend growth, we could only go back to 2010. That's when that factor picked up, because we only had dividend data going back to the year 2000. So that's something that if we could get that additional dividend data, we could certainly backtest that for longer. And we couldn't do international sales. That's something that we produce here internally. It's not available from a vendor. So our chosen factors seem to generate significant alpha. As I said, though, we didn't test international sales and 10-year growth. Now, as an alternative to SCHD, we built our own universe and our own portfolio, and you can see that here where each of these 7 factors, we've averaged those across our universe. So the point here is that if you remember the rule of 72, your income doubles in just 7.5 years at a dividend growth rate of around 9%. So the universe average is 9.6%. And you remember my earlier comment about having $1 today and having that worth $3 in 20 years. Well, this is how you do that. So remember that you can always torture the data and make it say anything you want. People are always asking us about performance, and that's why we don't spend a lot of time talking about it, because you can always play with the numbers, make them say what you want, and then everybody else has a different opinion about that. And you spend all your time trying to prove that you're a BSD instead of just executing on research and helping people become better investors. Now, backtesting a subjectively selected Quantigence portfolio, such as the one that we manage, is very tough. It took 2 analysts 3 months to do the work that we described today. So you need to run any sort of subjective strategy for about a decade or 2 before performance actually means something. And what's nice about Quantigence is that It allows for subjectivity, so people of various ages can tailor their strategies to their own needs, for example, growth versus income. And I think that an objective application of the factors such as the CRB strategy we've described today would work very well for an ETF. And I've lost track of how many times people ask us when we're going to develop an ETF on this strategy. And it's certainly something that we're considering. It's going to be a lot better than some of the shite high-yield gimmick strategies we see peddled to investors these days, but it's also a veritable rabbit hole of future work. Now, the takeaways: a factor-based dividend growth investing strategy outperforms in a huge way when you use quarterly rebalancing. So simply rebalancing based on Q scores provides loads of alpha, and you could potentially do that at intervals, for example, yearly instead of quarterly. Again, lots of different things to tweak if you're doing backtesting to look at various inputs. A fine-tuned linear portfolio, such as we manage here at Analyze, will likely outperform as well. Trimming overweights to buy underweights has shown to, in this paper, provide a lot of additional performance. And of course, there's action items aside from the results we've discussed today. So on our end, we want to explore, and we've always wanted to do this, objective rules in our strategy for rebalancing, for example, overweights or sustained Q scores that decline over time. This is something that we do internally, at least regarding overweights, but we'd like to quantify that and make it more objective. And then, of course, as I said, consider how we might use this continuous rebalancing strategy in an ETF product. So for those of you that aren't overly familiar with SCHD, you ought to see this video we did on really looks at a complete analysis of SCHD. It's everything you need to know about that ETF. So please make sure to like this video. Thanks so much for taking the time to watch this today.